The Federal Reserve raised interest rates on Wednesday, sparking a global rally in equities. Let's get straight to London. That's where Simon Smith joins us. He's the chief economist at FxPro. And Simon, your reaction to this historic move by the Fed?
You say it's historic, and that's very, very true. But in terms of market reaction, it's very muted. And I think there's a big difference there. Why? Because the Fed has trailed this so much and has massaged markets and led them to believe this for over 2 years already. Once we had the taper tantrum, it was called, back in 2013 when QE was being tapered away. So historic, yes, but actually the market reaction, as you say, very muted. But also, I think, positive in as much that yes, we saw the 2-year get up to 1%. We've seen positive reaction in equity markets as the Fed has painted what they paint as a relatively cautiously optimistic view of the economy, and with plenty of references to gradual, I think 2 in the FOMC statement, probably 6 in her opening statement to the press conference, and more references to gradual in the Q&A. So that's very clear.
Well, I think stocks reacted pretty positively. We had stocks in the U.S., Europe, and Japan all up well over 1%, where many analysts were worried about a sell-off should the Fed, following that rate hike announcement. But in terms of the pace of rates going forward, that dot plot chart that everyone talks about, it seems as though the consensus among Fed officials is that rates should rise to about 1.375% by the end of 2016. What do you make of that?
Yeah, as we know, if you look beyond that, so the next 2 to 3 years, that dot plot has come down quite a bit as the Fed's projection of rates has come more in line into market. But taking it to the short term, I don't know. I think most will probably see 2 rate hikes next year. I think the Fed is going to take it pretty gradually, more gradually than the dot plot and probably the markets are pricing at the moment. So I could see some further downward revisions on that, just on probably the still slow recovery in core inflation to what they perceive to be a comfortable rate. And then Yellen, I think earlier this month, underlined that it will remain data dependent and very focused on that recovery in inflation.
Right, and does it worry you that as the Fed hikes rates here, I mean, the European Central Bank is set to announce more easing in 2016?
Worry? No. I mean, it's just a natural consequence of the different cycles we have, the structural issues we have in Europe, and the fact that the ECB was so much later to the quantitative easing game than other central banks, years later, and also don't forget, did also hike rates back in 2011-12. So, a very different picture we're seeing. I guess, if we do see the dollar rise, then that could actually, benefit. If we see the rise against the euro, if we see go through parity and lower, then that could provide a bit of inflationary stimulus to the eurozone.
And today we actually saw the euro lose steam against the dollar.
Yes, we did. I think again, on the dollar index, we're about sort of around 0.5% higher. The euro dollar's all been about positioning, as you know. Going into that ECB meeting, they was disappointed. We saw huge short covering rally on euro dollar. So I think we're just getting that shakeout is now coming to an end. But I think overall, yes, we did see the dollar rise about 0.5%, and that's probably consistent with the move we saw on the 2-year.
All right, let's talk about which emerging markets you think will be affected by higher rates, because it goes back to this idea that if the economy in the U.S. is getting stronger, the U.S. is more stable than emerging markets, why park my money in EM when I can get a better return in the U.S.? In other words, the compensation I'm getting in EM for that extra risk may not be worth it. Yeah,
I mean, the whole structure of EM has changed massively. We've had rates coming down as some of them. Naturally, the US rate rise just narrows the carry differential there. It's been treacherous trying to trade EM the last few months. Naturally, trying to pick a turning point has been like catching a falling knife, because you can't really. It's hard to short EM currencies. There's a negative carry on there. It's not a good game to be playing. But if you look initially now, we've seen some recovery, especially Turkish lira has come. Dollar Turkey has seen a decent recovery just below that 3 level. And I think that's again just the sort of the relief we're seeing. At least initially, I think that'll be harder going in 2016. But at least initially, emerging markets is breathing a sigh of relief.
All right, Simon, we have to leave it there. Simon Smith, chief economist at FxPro. Simon, thanks for your time.